Good morning, everybody. Good morning, good morning, good morning. First of all, I'd like to ask a quick question of you all. Could you just put a little chat note in the chat section just to confirm you can actually hear me, first of all? Because we had a little bit of a sound issue last week. So if you can just check, just quickly put a chat message to say loud and clear or something like that, please. And that way we should be able to then get started. If somebody can just confirm that for me. Can you hear me? Can you hear me? Yeah, great. Okay. So welcome to today's webinar. Today's webinar for CCI traders is all about how you can excel as a trader. So how you can be the best possible trader you can be. I'm also going to cover during this webinar one of what I consider to be the holy grail of trading, which is risk management. How to control your risk, how to control your risk in relation to your reward, how to really adapt that and how to utilize that to the most effective way of doing this. Now, these webinars we do very simply. There is going to be a opportunity for you all to ask questions. So you can ask questions in exactly the same way that you did with the chat window down on your bottom right hand side, which is just down there. I will answer the questions at the end. So I've got lots of content to give you. I can see we've got lots of people signing in as we speak. And just a reminder, guys, you can join these webinars before 9 o'clock. What's happening is that 9 o'clock comes and everybody starts to join them, and it takes a minute or two to join in, and we start promptly at 9 o'clock. So you can actually register before that. You can register once you have the link, and then you can join the lobby and you can wait. And as we start, you come straight into the room. So I see we've got more people joining as we speak. So I'm just going to delay a little bit before I start so we get the most people in the room. CCI traders have asked me to do these webinars. I'm proud to work with them, and I've been traveling and all over the world for the last 10 years plus now, teaching and training people how to make money from trading the financial markets. Australia, Africa, Europe, all over the world. Been trading and teaching people how to do exactly that. So I'm delighted to share my wisdom with you all, share what I have with you all. And today's webinar is the fourth in a series of webinars where we are going to share with you how to excel as a trader. So for those of you joining now, we're going to teach you how to excel as a trader, the key fundamental elements that you need to be able to do that. As I said, there's going to be ability to ask questions at the end, which is fine. And today's webinar has a lot of dialogue. There is a video accompanying it. But the dialogue is important. So I'd like you to make sure you have a notepad and a pen available to make notes, key notes of some of the things that we're going to be learning today. Because it's important, okay? There's lots of dialogue. There's lots of text on the screen. We're going to look at some charts as well. And we're going to look at how you can really capitalize on these opportunities. Greetings to you too as well from London. So those of you just joining, thank you. Morning to Sierra Leone. So yes, the whole idea of these webinars is to give you education, and CCI traders have a great offer on, as you know, which is the $200 education bonus, which will be given to you by watching these webinars and this education that we're doing. So you just need to pop over to their website. I'll give you details of that later. But the whole idea is that we are going to be able to give you quality education to get you started as a trader and get your trading to become more streamlined and become more user-friendly. Because when people come into trading, they want to be able to do this properly and get a result from it. And you have to set yourself up properly, because somebody like myself can help you do that. Setting yourself up, but also continuation as well. So Today's webinar, we're going to start now. We've got quite a few people logging in. We've got people coming in all of the time, I can see. So just to those of you that have just joined, what we're going to do is I'm going to give you the ability to ask questions, which I will do so at the end. So at the end of this section, I will ask questions then. So the questions you can start to type throughout the webinar. So they are there. And then as soon as the webinars come to an end, I will then go straight to the questions. I won't necessarily read your name out unless you want me to, and then we can then answer those questions to the best of my ability moving forward. So I hope that's okay with everybody. Just wait another moment or two because I can see people joining all of the time. We've got people from all over the world here, it looks like. Africa, Asia, and London as well. Hi, morning from London. You're just up the road from me, it looks like. So, yeah, so we just wait another moment or two, and then we'll get started. But make sure you have pen and paper, guys. Make sure you take notes, key notes of what we cover, because it's important to have those notes to refer back to. But I say the first part of the webinar is about how to excel as a trader. Lots of information, lots of useful information. I'll be talking quite a bit about what you need to do and how you can work this moving forward. So we'll get started now. Over to the webinar video, and I'll come back to you at the end once we're finished. Hi and welcome to today's slides on this webinar. Today we're going to talk about what makes a great trader and also reward to risk management and how that can help. So without further ado, let's get going. So what makes a great trader? This is a question that's been asked of me by many beginners. They've said to me, Mark, what do I need to do to become a great trader? And the reason they ask me that is because they want to simply replicate the skills and the traits that a great trader makes. I'm often asked, what did I do before I was a trader? And I often ask, why would you like to know that? Or I might reply and say, well, what do you do right now? And the reason I do that is because the background of all of us is really, it's important in one way, but it's not important in another. And let me explain what I mean by that. Your current profession or your previous profession has no bearing into whether you will become a great trader or not. You can be a lawyer, you can be a driver, you can be a housewife, you could be a student, you could be a chef, you could be unemployed, you can be from any background and become a great trader. So the current scenario of what I did before is only being asked because to see if there's any commonality. Somebody comes into a training course and wants to learn, and if they know that the person teaching them used to be a chef and right now that person has become a great trader, that new trainee who is now also a chef feels that he's got much more chance of becoming successful because he comes from the same background professionally. It doesn't make a difference. What makes a great trader are key fundamental things, and it's not to do with their professional background. Firstly, great traders aren't born. Great traders are certainly not born, they are created. Nobody is born successful. Nobody is born professionally successful. They have to earn it. They have to create it. They become. What I mean is that they learn of the key traits, I should say, a successful trader has. The key 3 traits that a successful trader has are as follows. All 3 of them are essential if a trader is going to be successful and great. And let's look at these right now. The first one is a serious attitude. A serious attitude to trading. A serious attitude to being successful. A serious attitude to becoming great. We're going to look at these individually. The second one, a decisive nature. You have to be decisive to be great at what you do. Look at all the great sports people, the great actors, the great business people, the great people in life, the great leaders. They all have a decisive nature and a serious attitude, come to think of it too. They won't get very far in whatever field they are in without being able to make decisions. And a committed approach. They must have a committed approach. These are the three key traits a successful trader has. Somebody who's going to be a great trader has a serious attitude, a decisive nature, and a committed approach in bundles. Let's take a look at each of these now. So the first one of these is a serious attitude. A serious attitude is what we're going to cover first. A serious attitude is key to becoming great at whatever you do. So if I can help you become a great trader, but also great at something else, then I've more than exceeded my expectations. But here obviously we're talking about trading. But a serious attitude is key to becoming great at whatever you do. Adopt a take it as it comes attitude, or a see how it goes attitude at your peril. What I mean by this is that if you are starting something new and you don't have any focus on being serious and you just want to see how it pans out or see what happens or see how it goes and not drive the project with a serious attitude, the whole thing will come crashing to the ground. There is a lot at stake when trading. Money, your hard-earned capital is at stake, which can lead to your relationships too being affected and your livelihood. All of these three things are at stake when you're trading. So a serious attitude is so crucial and one of the most crucial elements for you to have to become great as a trader. A serious attitude is key to protecting these three traits: money, relationships, and livelihood. So you should be serious, and serious about your education, your risk management, and the decisions you take. Those who don't take it seriously often fall by the wayside, and that is a fact. I've coached many people in my life, and those that aren't serious, often you don't see again, because they're not serious about it. They're not dedicated enough. They're not serious to make it happen. So how do you adopt a serious attitude? You consider the consequences of not being serious. Look at a serious situation and look at somebody that's treated that serious situation with contempt. Look at the consequences that would happen if you don't take a serious attitude. Always look at both sides of the story. Sometimes it pays to be light-hearted. Sometimes it pays that you need to be serious. Be very analytical about the story and the scenario, so you actually look at both sides of the story. Do I need to be serious here? Do I need to be light-hearted? Give yourself strict goals and deadlines. That's how you adopt a serious attitude, because if there's a lot at stake, as we spoke about, but you've got a lot to gain, then your serious attitude will come naturally. Accountability to yourself, to your family, and your loved ones. This is a big one. Nobody likes to fail, least of all ourselves. But failing ourselves and knowing we've failed ourselves is one thing, but then failing your friends and family and your loved ones is another. Have accountability to them. Look at case studies of people that have become successful, and look at case studies of people that have failed in life. And I bet their serious attitude somewhere along the line is a common denominator in those that are successful. Think of your past key successes and fails. Look back in your life. Take a moment or two to think back now as to when you were successful and something key in your life. Were you serious about it? You can probably safely say you were. But look at some of your fails. Look at how serious you were about that. Possibly you were less serious. And that is the key I'm trying to get, the key point I'm trying to get across. If you have to, learn from your mistakes. crucial and important to make sure you understand. Now we talk about decisive nature. Decisive nature, and this is where you need to make decisions quickly, swiftly, and effectively. A decisive nature is key to becoming great at whatever you do. None more so obvious than trading. You've got to decide whether you're going to take the trade or not. If you dilly-dally in between, you're just going to get frustrated. There are lots of decisions to make as a trader from day one. Some of you have already made them. Decision to be spending a few hours listening to these webinars. You're obviously getting a financial benefit with the $200 education bonus, but you're learning value. You're getting value, you're getting educated, you're getting valuable information and valuable inspiration from somebody who's been doing this for a bloody long time. You need to decide about the trade itself. The trade itself. Education decisions, expensive or ignorant. So not only do you need to decide whether to take that trade or not sit there in between and on the fence, you've also got decisions about your education. And this is where I want to talk a little bit about and focus a little bit about education. Because many people over the years that I've spoken to that are interested in learning how to trade, they want to go on a residential course, or they want to learn from a one-day online course or whatever it is, most people have this inbuilt resistance to want to spend money on that. And that's what we call an education decision. And they would then turn to look at the cost element of their education and come to the conclusion that education costs or is expensive. What I normally do is look at it on the opposite side and say, look at the cost of ignorance. Because many people who try to cut corners with learning how to do this properly will invariably lose money through their trading and then want to come back and be educated in the secondary place. In which case they lose the money twice, because they've invested the money in the trading and got it wrong, and then they've had to invest their money again in their education, or not even bother and quit. How sad is that? So the point I'm trying to make is, in education, decisions are important. Education costs. Most trainers and coaches have invested time and money in their knowledge and years perfecting their craft. So we're not charging for our time per se, we're charging for our experience. So education does cost. Make your decision and make sure you are educated by the right people. I tend to teach people how to trade and what to do so they can build their own trading strategies themselves rather than give a trading strategy per se. I can do so. I can give trading strategies, but I firmly believe that great traders are great traders because they take accountability to themselves and not just copy someone else. Also decisive about risk management. Are you adverse to risk or are you positive? Are you somebody who looks at a trade setup, looks at a scenario, looks at something and thinks, oh, what's the risk to this? Or somebody that looks at it and goes, wow, look at the gain for this. And the best way to describe that is if you saw in front of you a bag of $10,000 in US dollar notes and you found it and there was no one around, would you A, invest it, or B, would you spend it and put it onto maybe bills that you've got or outstanding debts or whatever it might be, or buy yourself something nice? An aversion to risk would be somebody who would spend it and clear their debts or whatever it is. Somebody who's positive with risk would take that $10,000 they found and invest it and look at trying to grow it. That is how to have a decisive, a difference in a decisive nature when it comes to risk management. We're going to cover risk management in a bit. So a decisive nature leads to a quicker outcome. But of course, this is better than no outcome, because you can be decisive and make the wrong decision. But I'd much rather people be decisive and make wrong decisions and learn from it than make no decisions at all and have no outcome. This will give confidence to the person, and especially in trading, the more decisive you become,
the more confident you become. It will create activity for you, because the more confident you become, the more activity you create. And you will learn much quicker by being decisive. Those who are not decisive tend to later have lots of regret. So how to adopt a decisive nature? Well, consider where you would be now if you weren't ever able to make decisions. Think in the past, as a child, when we're born as babies, our parents make decisions for us and they tend to, take care and nurture us as we grow up. But as we grow, we're then able to make more decisions because we become adults. So think about where you would be now if you weren't ever able to make your own decisions. You would probably be managed, manipulated, and or mothered. And I think trading is the ability to, and this is something I'd like you to write down, is trading gives you the ability to later make choices. If you make the right choices as a trader in the early days and be educated correctly, then it gives you the freedom to choose later in life what you do, when you do it, and who you do it with. But if you don't make the right choices in the beginning, then the choices later are still there, but they're not made by you. They're made for you by somebody else. Risk assess the work in hand. How to adopt a decisive nature is important. Risk assess the outcome possibilities on either side with a positive or a negative outcome. This will prove sometimes that your fear that you may have is unjust. What's the worst thing could happen? Start to reward yourself for making quick decisions as well. This is so important. Make a quick decision, whether it's right or wrong, but reward yourself for making that decision. Think of your past key successes and fails. Look at your key successes. Were you decisive in those days? Did you make a decisive attitude? Did you have a decisive nature at that time? Or were you indecisive? It's no secret that people who are decisive have key successes in their life. And people that are indecisive often fail. If you have to learn from these past mistakes and how, whether it's right or wrong, but reward yourself for making that decision. Think of your past key successes and fails. Look at your key successes. Were you decisive in those days? Did you make a decisive attitude? Did you have a decisive nature at that time? Or were you indecisive? It's no secret that people who are decisive have key successes in their life, and people that are indecisive often fail. If you have to learn from these past mistakes and how those mistakes made you feel. We're now talking about committed approach, a committed approach. A committed approach is crucial to being a success. Lack of commitment is a lack of belief, which leads to a lack of results and so on. Let me show you what I mean by that. It's a cycle that is hard to break. It's what we call the belief cycle. We have belief. If we have belief in what we are doing and belief in ourselves, then we will take action. And by taking action, we get results. We get strong results. We get results which reinforce our belief again. And the cycle starts again. We get stronger belief. We take stronger action. We get stronger results. But if we don't believe, we don't take action. Because if you don't believe in yourself or believe in what you're doing, you won't do it. So you won't take action, and guess what? You won't get any results because you haven't taken any action. And then the belief spirals downward and gets less and less and less until it becomes zero. And zero belief means zero action and zero results. Not a good place to be. It's all about belief. Belief is because of a lack of commitment. So a committed approach will allow you to stick with your plan regardless. It will allow you to see the results and adapt those if you need be. So you need to be in a position where you see the results, and if you're not happy with them, you can adapt those the process accordingly. You can learn new things with a committed approach. It's so powerful. You can grow and you can prosper. Those who don't commit often quit and move on to other things with that negative approach, and then do the same thing again with something else and fail at that as well. And it's all about having commitment to the cause, which causes the knock-on effect of belief, action, and results. So how do you adopt a committed approach? Well, think back to your achievements in life. Think back to your achievements in life that you've done really well and how committed you were to achieving them. Whether it's parenthood or university or opening a business or getting that job interview or just purely beating an illness, whatever it was. Think back and how committed you were. Compared to those things you tried but didn't achieve. So look at those compared to the things you didn't achieve at. A committed approach is probably one of the things missing in where you didn't achieve. And that is something that you need to take a few minutes and moments to think about very carefully, maybe after this webinar. Stick to your guns. Make your goals worthwhile. Reward yourself frequently. Spend quality time with a loved one. So if you are committed, give yourselves rewards every time you give yourself an achievement or achieve something in your milestones. Spend time. Take a loved one out for dinner. Spend time rewarding yourself. Treat yourself because you've achieved something special. Give yourself something special in return. And draw an on-off scenario, one with a committed approach and one without. So get a piece of paper, draw down the middle, and the things on the left which are committed and the things you aren't committed to, and try and get them all over onto the left-hand side. So, you have all that sorted. What else is it that sets the great traders apart from the average trader? An average trader is somebody who, is okay, is doing okay, wins a bit, loses a bit, nothing really sort of world class, nothing earth shattering, compared to somebody who's doing so well. He's got money, he's trading for other people, he's got MAM accounts, he's earning revenue shares, he's doing really well, and he's really changed the outcome of his life. So what is it that sets those people apart from the average trader? A good solid education is one of them, for sure, without a doubt. Great trading psychology. We covered that off in one of our previous webinars. How you can have a great trading psychology. Overly stocked toolkit. Now I love this. You need lots of things in your toolkit. Most professional tradespeople go to work with a toolkit. Spanners, screwdrivers, knives, blowtorches, kit to do their job. Traders should do as well. Make sure your toolkit is overly stocked with your coaching and your strategies and your mindset and your positive attitude and your capital. Make sure your toolkit is overly stocked. You can never have too much of anything of like that. And a thorough understanding of risk-reward management. That is key to being a great trader. Okay, so let's talk a little bit about risk-reward management. In this case, we're talking about risk. So risk, there is an element of risk in most things we do in life, and that's none more so obvious than when you are investing. Property investors know that when they're buying property, investing in property, or investing in whatever it is they're investing in, whether it's business or companies or whatever it is, there is a risk attached to it. Specifically here, we are talking of risk applied in everyday trading. Trading currencies, trading stocks and commodities, trading indices, trading crypto. There is a risk involved in all of that. So how does risk affect us? Rarely in trading is it a win-win situation. Now I need to make this very clear to you. If you are new to trading, or even somebody who's been in trading for a while and have the belief that you should never lose a trade, then I need to correct that. Because no successful traders in the world, no great traders in the world have got to where they are through never having a losing trade. If somebody ever says to you, I never lose a trade, or they're offering you something with 100% win ratio, then they aren't being honest with you. I need to make this very clear to you. Traders do lose trades. Trading is not a win-win situation. There is risk attached to everything you do. It's accepting it and understanding it and making sure you are managing it. Every trade can be a winner, I agree. Equally so, every trade can also be a losing trade. Knowing how to manage your risk is key to getting a handle on this scenario. So, let's talk a bit more about risk. Before any trade is placed, you should establish where you are going to exit if it goes wrong. Absolutely. Every successful investor always has an exit strategy. An exit strategy from a property deal. An exit strategy if they're investing into a company or into business. They want to know when they're going to get out of that investment. So before any trade, you should also have the same for you. This is called a stop loss. You'll see the word stop loss or the letters SL appear on your broker platform, on CCI Trader broker platform. Whenever you place a trade, please make sure you use one. It does exactly what it says on the tin. It will stop your loss from being excessive. It's a level where if you are in a buying trade, so if you're, say for example, buying euro dollar and you want price to go up, the stop loss will be placed below your entry price. If the price falls instead of going up as you desired, it will stop the trade from losing excessively. Therefore, stopping the loss from being excessive. The important part is stop and loss. Stopping the loss from being excessive. Simple, eh? But if I told you many people don't use stop losses, would that actually surprise you? What I've described, what a stop loss is, and what it does, and how effective it is, does it surprise you that many people don't even use them? Does it surprise you that many people don't even use them? It's a protection. It's a safety zone. It's sensible trading. And above all of that, it's staying safe. Still, traders don't use them. Now, I'm sure there's some of you sitting there thinking, well, why? Why? Please tell me, Mark. Well, I've always wanted to know why. And I suspect the reason why traders don't use them, and I've looked at this for many, many years, and the conclusion I've come to is, and don't laugh when I tell you, please, it's because they don't like them. Traders don't like stop losses as they stop them out of the trade. They would sooner rather keep a losing trade running and running and running and running in the hope that it becomes a winning trade. And eating into their margin and eating into their leveraged margin account. Getting margin calls from brokers. Getting their balance reducing down just because they hope that the trade comes back the opposite way. They don't like them because it stops them out of the trade and stops them from becoming a winning trade. Guys, you will have losing trades. You have to accept that. Risk management is so key. Crazy, I know, but that story I've just given you is true. I've met many people who have trained and learned how to trade so they think, and then when it comes to risk management, don't use a stop loss. Crazy. Stop losses should be considered your friend. Stop losses are even more important than a target or your entry. Stop losses, when used correctly, give you as a trader a solid edge when you're trading. Because if you've got a losing trade running out of control with no stop loss, and you let it run, you're eating into your margin, which is the money in your account available to trade that your broker will use. You can't place any other trades, and you could be missing out on some other winning opportunities just because you're trying to nursemaid a stupid losing trade. Stop losses. Get used to using them correctly, guys. Markets can move so quick that without effective risk management, a single trader can lose everything in their trading account, whatever size that is, on one trade. Yes, I repeat that. One trader can lose absolutely everything on one trade. Because every trade has a risk attached to it. You have to manage that risk. The biggest mistake beginners make when trading is not accepting this. And because of that, they go in with a gung-ho approach. I know of a story, I don't know the person personally, but I know of a story of a guy who heard that Apple shares were going to go up in value. And he bet everything he had, including his house he remortgaged, on the fact that Apple shares were going to go up. Guess what happened to Apple shares? He went into the trade with no stop loss, just in case it went wrong. He put everything on that trade with no stop. The trade bombed out. The trade lost money, and it didn't stop with the stop loss. It stopped when the whole margin was called on the account, and the money left in the account went to zero or below. Look at oil. Oil went to negative pricing. Trading accounts can go negative if you don't have proper risk management. Suffice to say, the guy lost money, he lost his house, and he lost his family too, because he had a gung-ho approach and going in on a whim and going in on a rumour. Successful great traders accept this scenario and manage risk effectively. They adopt a where shall I get out of to goes wrong approach. So where should I get out of this if it goes wrong approach? Always have a get out of jail card available for yourself. Stick to it rigidly. So important. Don't deviate from that. And this is what a stop loss is used for. Those who don't use stop losses can lose all of their money on the current trade they are in. And please remember that. Let me show you now in a video why that is. Okay, so what we have here in front of us is a trading chart on the Euro Swiss franc exchange rate. This is a daily chart, so each candle here is 1 day. You can see that because it says D1 just there. Now, Euro Swiss exchange rate, as you can see, this is the 2nd of January 2014, so 6 years ago. And this is the whole year. So as you can see, for the whole year, the Euro Swiss franc exchange rate was just bouncing along sideways. And the reason for this was that the Swiss National Bank had put in what they call a floor. It was pegged. Euro Swiss was pegged to 120. So that's 1.2000. This was to stop the euro from weakening further and the Swiss franc from strengthening further. And this was actually manipulation by the Swiss National Bank, but many people were trading this. I don't know why. I wasn't. And I know many people out there were trading it, but I don't know why, because it's so unsafe. Because any time this could change. There's no movement to the upside and there's no movement to the downside. And if it was going to go anywhere, it was going to go up. Purely and simply because there's a floor there preventing it from going any further down. So the only way it can go is up. The following video will show you what happened next. Okay, so in this video what we're going to show you is exactly what happened to the Euro Swiss franc exchange rate, and the date it happened was the 15th of January 2015. As you can see on the daily chart, the euro and Swiss franc
was just consistently trying to fall, putting in lower highs and lower lows. And what happened, of course, was they then decided to prevent it from putting any lower lows and lower highs in, but put a peg in place. So the peg was put in at 1.2000. And in essence, that was there to protect the exchange rate from weakening any further, therefore weakening the euro, strengthening the Swiss franc. And if a Swiss franc gets too strong, then it will affect the economy, it affects tourism, import, export, all that sort of thing. A strong Swiss franc is not good for an economy if it's excessively strong. What happened next, I need you to watch very carefully. I'm just going to move the chart on a little bit and watch what happens to the price. Notice that right now this is in a range. This is in a range, okay, very tight range here for the whole of this year. So this is the whole of 1 year of between 1.2000 and 2028. Yes, it's got previous years worth of price action, but I'm just going to move it on 1 bar. And there we go. It's moved on 1 bar, and now it's changed the complete ratio of the chart. It's now showing us just 1 year. In fact, 18 months of data. But what I want you to show you is here. This move here, which you can see here, was a massive move. The whole of the charting system went haywire. It went crazy. And this particular price, this day, on the 15th of January 2015, it moved 2,272 pips. 2,272 pips in 1 day. Not just in 1 day, the most of that move took place in the morning around 9:30 UK time, which was 10:30 European time, and other times around the world. And it was because the Swiss National Bank removed the peg that they had in place. They removed the floor that was sitting here at 120, preventing it from moving any lower, was just removed. It was costing far too much. It was costing billions of euros a day, and then the Swiss National Bank just pulled it away. If we just move on a little bit, you can see it did recover a little bit. But that is what happened on the 15th of January 2015.
Okay, so now you've seen the video clip of actually what happened. This is the aftermath, and the aftermath was just damaging. This move here was a move of ridiculous proportions. It moved a ridiculous amount of pips. It really did. As you can see, it did recover over the coming weeks, and eventually, you know, it tried to get back up to where it started eventually. But the whole point is that if you were in this trade, you would have been completely blown out of the water. And this is the point I'm making with regards to risk management. Amount of pips. It really did. As you can see, it did recover over the coming weeks, and eventually
January 2015.
Okay, so now you've seen the video clip of actually what happened. This is the aftermath, and the aftermath was just damaging. This move here was a move of ridiculous proportions. It moved a ridiculous amount of pips. It really did. As you can see, it did recover over the coming weeks, and eventually, you know, it tried to get back up to where it started eventually. But the whole point is that if you were in this trade, you would have been completely blown out of the water. And this is the point I'm making with regards to risk management. First of all, you shouldn't have been trading a trading strategy on Euro Swiss. Euro Swiss was a no-no. And Euro Swiss, the thing that happened with Euro Swiss is not going to happen again for many, 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 many years. But the point I'm trying to make is Risk management. Look at what you could lose when you go into a trade. This trade here, again, it's just unprecedented. It won't happen again for decades and decades. But traders who are trading this could have lost money, could have lost their shirts, and I know one brokerage went out of business that day that were offering this particular trading pair to its clients, to its traders. So the whole point of the exercise here is risk management is there to help you. If you don't use stop losses, then you can get blown out of the water and the whole thing is just completely destroyed. Using stop losses will prevent you from losing excessively. Now, all things being equal, stop losses wouldn't have helped you in a situation like this, but the point I am making is you can experience very big moves. You can experience 80 to 100 pip moves, 200 pip moves. This was thousands. Okay, this was thousands of pips in a blink of an eye. But 80, 100, 150 pips can move in the blink of an eye. So what I'm saying is that if you've got stop losses there, they are there to protect you and stop you from blowing your money. Now remember, leverage and margin is a big thing, and I will cover that on another webinar on how that's calculated. But stop losses are there to protect you. They're there to help you prevent your loss, and it's a very integral part of risk management.
Okay, so in that video you would have seen a completely unexpected move on a currency pair, which was the currency pair of Euro Swiss. And I remember that day as if it was yesterday. I was in London. I was running a training course in the London trading floor for a company I worked for, and we had a trading floor next door, and the noise that came out of the trading floor, which I could hear and see through the glass partition, was incredible. And by the time I'd actually just halted quickly and got into the trading floor, which was probably about 7 to 10 seconds journey of quick running, I wasn't walking, I was running. By the time I got there, Euro Swiss had fallen off of a cliff. And it literally had fallen off of a cliff. And the Swiss National Bank pulled the floor away. They'd released the peg. They'd pegged Euro Swiss at 120, and they'd pulled it because it was costing billions and billions and billions of euros on a daily basis to keep that thing propped up. And the euro, by that time, I'd turned around to a certain extent. The Swiss economy was more stable, so they felt there was no more need to do it. Didn't give any warning, and bang, the whole thing went. And Alpari was a brokerage called Alpari actually went out of business that day. They ceased operating because of the losses that were incurred in that marketplace. Now, that, as I said before, they don't happen all of the time. These sort of things happen once in a blue moon. I can't see anything like that happening for years and years and years and years and years. But risk is there. But stop losses are so important. I can't stress those enough as to why stop losses are so important. Moving on to reward. Now, reward is important as well, and there is a relationship between reward and risk, which we will cover. But where there is a stop loss to prevent excessive loss, another often overlooked factor is reward. Traders have missed vital profit through not having a take profit level on a trade. So let me give you an example of what I mean by that. A trader places a trade one day. They let it go into the market and they let it run until they want to come back to it and look at it the next day. And when they come back the next day, they see that the trade is pretty much where it started. It started at one level, and when they come in the next day, it's pretty much where it started again. But what they then see is between the time it was opened the day before and today, where it's virtually at the same price, the trade went quite a way, all the way up, and then came all the way back down again. And had they had a take profit level at the top or halfway up the top, then the trade would have banked profit. So there's nothing worse than going into a trade with no take profit, knowing where you'd like to get out if you were sort of watching it and thinking, oh, that's enough, I'll take it off the market now, and doing it on a whim
and not having it calculated and not having it set for you, and then noticing that level was hit but you didn't have a target. That is so damaging, because it's emotionally damaging. So targets are there. They're important, and a target is put onto your trade in the form of what we call a take profit level. So it's TP, take profit, or just simply target. You may see that written down on your trading platform. So how does it work? Well, a take profit is placed at where you, the trader, wants to exit the trade and take profit. If you don't do it and just think it, how does the broker know when to come out of the trade? You've got to tell the broker where to take your profit. CCI traders will want to know where your profit levels are. If you don't put a profit level on, the trade will just keep running. Without it, the only way a trade can exit, other than a stop loss, and we've covered that one off already, no trading with a stop loss, is to trade it manually. So to exit it manually. But of course, if you do what I said earlier and say, well, I'll place the trade today, I'll come back tomorrow, and if I want to exit it manually, I will. But you won't, because it's at the same level where it opened, but you missed all that opportunity to the upside. So without having a take profit or a stop loss, the only way a trade can stop is to exit it manually, or on the real negative side is if you get a margin call, which means you run out of money. A take profit level controls the reward on your trade and how much money you make on that trade if it is a winning, profitable trade. And that's done in conjunction with the trade size that you use. And we're going to cover that off more in detail later. Take profit levels should be more easier to reach than the stop loss. We'll have a look at some charts in a moment, but when you're looking at an entry price and you're looking at a target and you're looking at a stop loss, the levels that you place these targets and take profits and stop losses should be done in a calculated, strategical way. What I mean by that is, if you've got a stop loss that's been hit and easy to hit, price has hit it that level so many times, but your take profit is right up in the sky, it's not going to happen. So you want your take profit levels to be easy to hit and your stop losses to be protected, because you don't want your stop losses to be hit because you've lost the trade. Yes, they will do so, but have them protected. And when we come to look at charts in a later webinar, I'll show you exactly what I mean by that, where to place your stop loss. Traders have missed vital profit through not having a take profit level in an appropriate place. So for example, a take profit set too high in a buying trade can mean that you might miss the opportunity. It might get 20 pips lower than where your target is and then turn because there's a great big level of what we call resistance there, or there might be a pivot point there or something there preventing price from getting there. So take profit prices and levels should be in an appropriate place. So it is essential to trade properly and analyze your trade and the take profit level and stop loss level before you actually place the trade. That is important, and again, we can look at that when we actually assess a trade in a later webinar. If you don't do this, all you're doing is you're setting up a poorly analyzed trade that can end in unnecessary losses. Also, what is important is to understand the relationship between reward and risk. Let's take a look at that now. So now let's combine risk and reward together. When looking at the two together, it gives us the ability to think and act smart as a trader. Over the years, I've taught many people how to trade and how to trade the markets, one-to-one and in classroom situations, as many as 200 at a time. And many of those people have asked me at some point, Mark, how can I increase the risk percentage per trade? Up till that point, I've usually taught them to risk no more than 1 or 2% per trade as an absolute maximum. Any more than that, and you run the risk of wiping accounts out very quickly if you have a run of losing trades. But I still ask the question, why do you want me to increase the risk? Or why do you want me to show you how to increase the risk? And the answer is more often than not, always. If I risk more per trade, I can make more per trade. Makes sense. And it is true. However, if you risk more, instead of just 1 or 2%, and you increase the risk to 10 or more percent, and you have a run of losses, you will also lose more. Let's say you increase the risk to 10% per trade. So 10% of your capital is risked on a single trade. If you have a run of 5 losers, you will wipe out half of your account. Simple as that. Half of your account will be gone. You've then got to increase that account. So let's say it starts at $10,000 and you reduce it to $5,000. You've then got to do over 80% or more on that $5,000 just to get back where you started. Alarming, hey? So if you have a run of losses with a higher risk, you will lose more. Of course, if you have a run of winners, you will win more. But this is about looking at this systematically and safely. The smart way, of course, is to keep the risk low, yet increase the reward. Now, this is smart trading. When you win bigger. Keep the winning trades running. Kill the losing trades early. It's all about having bigger wins and smaller losses. You enhance the reward to risk settings so that you win bigger, and when you lose smaller. Pick quality trades over quantity, but wherever you can, pick quantity of the quality. Would make your life even better and even stronger. Let me show you how much of an impact adopting a higher reward to risk will make for you as a trader. Okay, so we're going to talk about the relationship between the reward and the risk. And in this example, we're looking at a month to view, 1 month of trading. 1-to-1 reward to risk, 10 trades with a 1% risk on the trade. A 50-50 success rate. So I'm using all of the round numbers to make this calculation demonstrate easy enough. What that means is that 50% of the trades out of the 10 would be winning, and 50% of the trades out of the 10 would be losing. If you're risking 1% per trade, then your 5 winning trades would be 1% each, which means a 5% overall profit from the winning trades in that period. Your 5 losing trades will be 1% each, which means that overall losing trades would result in an overall 5% loss. So your 5% gain minus your 5% loss would be a net result of 0. So you would have to adopt a higher success rate to be able to make money in a scenario such as this. So let's say you went to 60-40. That means you'd have 6 winning trades, 4 losing trades, 6, 4, which would result in a 2% gain. Now, many people, what they try to do is they try to increase the risk, so they know that if they have winning trades, that will give them a benefit. So let's change that back to 0, change this back to 5, change this back to 5, change this back to 50-50, but we'll increase the risk per trade to 5. So 5 winning trades at 5% each is 25%. 5 losing trades at 5% each, again 25%. So as long as you've got a success rate which is even, neutral, 50-50, whatever your risk is, you will always end up at 0 with a 1-to-1 reward to risk. Now, if you were to go here and have a run of losing trades, 6 losing trades, 4 winning trades, that would give you a winning ratio of 20%, or winning trades at 20%, and the 6 losing trades at 5 each would be 30. That would give you minus 10. Now, let's show you in real terms. If your 6 losing trades came first, in which case your $10,000, that would mean your losing trades would be reducing by 30%, so minus 30%, which means your trading account would be $7,000 at that moment. Your $7,000, add on the 20%, that your winning trades made you, would be 8,400. So therefore you would have a net loss of quite a substantial amount, $1,600 in real terms. That's because your losing trades were first and then your winning trades came after. So that shows you that having a higher risk can sometimes really eat into your profits that you take, what little profits you do have. So I'm going to put this back down to 1% risk, 5 winning trades, 5 losing trades, and I'm going to change these back to the 1, and I'm going to change the reward to risk to 3 to 1. So we're rewarding ourselves with 3 for a winning trade, but when we lose, we only lose 1. So this is based on 1% again. So our winning trades effectively will be 3% each, 15%, and our 5 losing trades at 1% would be 5, giving us a net result of 10% in a month. Okay, 10% in a month. Now let's play devil's advocate. If we had our $10,000 and we took off our 5%, which is for our losing trades, and assume they were then all in a row at the beginning of the 10 trades, that would give us $9,500. So our $9,500 here, and add on our 15%, that's going to be around about $1,400, which will give us more than what we started with. It's around $10,900. So what that basically means is, with a higher reward to risk, you can lose more trades than you are winning. So for example here, if we just get rid of this and have 6 losing trades and 4 winning trades, our 4 winning trades would be 12%, and our 6 losing trades would be 6%, which is a net return of 6%. So we've had a serious situation where our success rate is 40, and our loss is 60. So it's a 40-60 success rate, 4 winning trades, 6 losing trades, 3% for the winners and 1% for the losers. Now the only thing I would add to that is, when you have a higher reward to risk, your success rate can drop, but you can still make money and profitable. However, your losing trades, you need to get into accustomed to actually having more losing trades, and that again is a psychological thing to deal with. But that's how a 3 to 1 reward to risk or more can really help you grow your account. Let's talk about strategic placement now of our stop loss and take profit. It's all about the placement. I mentioned earlier about stop loss levels and take profit, or which might also be shown as target levels. Many trainees of mine over the years have asked me, Mark, where is the best place to put these? It's okay having a strategy, A moving average cross, for example, when the moving average is cross up, we want to buy, and when the moving average crosses down, we want to sell. But where do we put our stop loss? Where do we put our target price? What are the levels we want to go in at? Correct placement can be the difference between being a great trader and an average trader. Let me explain what I mean by that. If you look at a price chart and decide where is the best place on this chart where I can place a stop loss, somewhere that is difficult for price to reach. I liken it to a room. If you imagine the room you are sitting in, and where you are right now is the price level, and your stop loss, and you want to buy, your stop loss would go in the room beneath you, because it's got to break through your floor to get to the stop loss. Your target is lower than your ceiling, and that is for a buy. So you place your stop loss that is in a place difficult for price to reach. You then have the answer. A stop loss should be placed at a level where it's protected. It's away from harm's way. It can't be touched easily or reached easily. And at a level that is underneath support or above resistance. For example, euro dollar, the talk is that euro dollar will get to eventually 1.0000. Now it might go down to 1.0050 first and not hit parity for another few weeks, in which case you could have a buying trade and your stop loss could go below parity, because you know it's got to break through parity to get to stop loss. Parity meaning 1.0000. That's what I mean about placing a stop loss in a place that is difficult to get. Imagine having a target. A target we'll talk about in a bit, but a target should be easy to achieve. But this is all about the placement of the stop loss. Let's look at a chart and show you this. Okay, so we mentioned about placing stop losses and targets or take profits in appropriate places. So for example, let's look at this moving average cross. We looked at this strategy a while back. It's a moving average cross. The 50 is crossing the 200. The white is the 50. The red is the 200. And when the white crosses the 50, as you can see here, away we go. Nice profit, nice trade. But where do we put our stop losses? Where do we put our targets? Well, let's talk in this example about stop loss. Now, as you can see, if we were looking at this trade here, and we were seeing that we'd just seen the cross, and we want to get into the market, then what I would look at potentially doing is I'd be looking to put in maybe a stop loss somewhere like this, under there. Now the reason I put a stop loss there is because it's actually underneath a recent low. It's underneath a recent low, and clearly there is a level there where price has bounced, and it's got to break through there to get to my stop loss. Now if you want to be a little bit aggressive with your stop losses, then you could actually put one under there. Okay, because there's actually a level of support there, as you can see. The level there, bounced off of it, came down, bounced again, broke through, tested it, and now is above it again. So you could actually put a stop loss here as well. That would actually, or instead of, I should say, which will give you a tighter entry. So the less your stop loss, the more you can get onto the trade. And when we cover how we actually calculate CFD sizes on another webinar, you'll see exactly what I mean. But here I've placed my stop loss in a protected area. I don't want my stop loss to get hit, so I place a stop loss somewhere where it is difficult to get hit, underneath, for example, a buy trade, a level of support. A level of support being a price area where prices bounced here, broke through, and then come back and tested it again. And if we go back in detail, we may find that it's actually bounced again there before, as you can see. So these particular levels here that I've drawn on my charts are important. So we can use those levels to actually calculate where we place our stop loss for our trade. Okay, strategic planning also encompasses the level for your take profit or target. I mentioned earlier about stop loss placement, so now let's get into talking about the target or take profit placement. Many trainees again over the years have asked me, where is the best place to put my target? Correct placement can be the difference between being a great trader and an average trader. Let me explain what I mean by that. If you look at a chart, decide where the best place on that chart is where you can place your target. Somewhere that is easy for price to reach, somewhere that price has hit before, often more than once. Imagine it being like a room again, and you're in the room, you're sitting in a room, and your target or your take profit is for buying underneath your ceiling or for selling above your floor. That is easy to achieve because the resistance and support levels are outside of your target. Then you have your answer. A target should be open and easy to be hit, and at a level for selling that is above support, i.e. your floor, or below resistance for buying. Let's have a look at a chart and show you exactly what I mean. Okay, so we spoke earlier about stop losses, and we'd place a stop loss for this moving average cross strategy either below this level here or this level here for real ultra safety, because it's way below a low that hasn't been touched for a while. We're now talking about where to place targets. Now, targets, again, you want the target to be able to be hit. For example, if we go forward here, I'd be looking at maybe placing a target somewhere underneath this level here, because it's actually been hit before. So, having a target somewhere like this, because we know price has been hit before, is a good idea. If we place our target too high and place it up here, for example, let's just get my horizontal line and place it up here somewhere, then it's not going to get hit because the price has actually come up and it's hit through this level here. It's stopped at that level, which is a level of resistance. And again, I'm going to cover support and resistance off in great detail on another webinar, and then had another go and then failed, and everything's then just pulled away back down to the downside again. So the point I'm trying to make is, with your target placement, place your target in a place that's reasonably easy to achieve, reasonably easy to get to, but make it worth your while. Right now, as you can see, our entry price was around about here. So our entry price is going to be around about here when the moving average is crossed, and there is our stop loss. So at least you've got a more than a one-to-one reward to risk there. Okay, so let's delete that one, and we'll delete that one there. That is your stop loss, that is your risk, that is your reward. It's greater than one-to-one because you can get more than one of those spaces in there. Okay, so you've got then a good trade to take because it has a stronger than one-to-one reward to risk. If you put your target up here for a higher reward to risk, then you'll probably find it will never get there, or if it did, it will take ages and ages and ages. And as you can see, price as of today, which is the current price, is not even getting anywhere near where our target would have been right now. So it's likely to push up to this level again and then fall away. So that's how to place your target. Remember, place your target in an area that has been hit before, has a good likelihood it's going to get there again. Conversely, with your stop loss, you want to tuck it away under somewhere safe. Okay, so today we have covered some of the ways in which you can excel as a trader, and I hope you've got a lot of information that you can take away and use. And also we've covered reward to risk management and how you can adopt a higher reward to risk management, but keep the risk low but get your reward high. That way you don't blow accounts like many people have in the past because they've got greedy or they've tried to excessively risk. Up next time is the next webinar. We're going to cover trading as a beginner, the important things you can learn and the important processes you can follow as a beginner in this trading environment. You know, I've got a lot of experience in this industry, but how you can adopt and apply yourself as a beginner, the sort of things you need around you, the sort of things you need in your business, the sort of things you need to know. So it's really one not to be missed. It's going to be next week, Wednesday the 3rd of June at 9 o'clock British summertime. And again, as always, we will get the link sent out from us CCI Traders and we can take it from there. Now remember, at CCI Traders, ccitraders.com is the website if you want to get your demo account set up and your live accounts opened. And with regards to funding, remember you've got your $200 educational bonus as well as a new trader. So CCI Traders are really supportive of your stuff moving forward. So let's move back over to the portal to see what questions we have and we can take it from there.
Okay, guys, so I am back. Hopefully you can hear me. We've got some questions. I just want to correct one error. It's ccitraders.net is the website address for CCI Traders. So I've got something to share with you in a moment, which is a simple screen with ccitraders.net where you can open an account. Because I can see one of the questions down here is how do I open an account? So I'm going to cover that off in a moment. And remember, the $200 educational bonus is what you get as well for watching these educational workshops. So I do hope you picked up some valuable information there. I know it was a lot of talking and you know, there was obviously some diagrams kicked in. And I noticed one of the questions, so it wasn't a question, it was a comment that come up around 9:40 in the morning when I showed you the Euro Swiss. And the simple word was wow. And it was exactly the same thing of what happened that day. It was a wow because the market move was really unprecedented. I've never seen anything move so quick. I probably won't ever see anything move so quick again. So yes, it really was. It really was a quick move, and just goes to show you with effective risk management how you can be protected. A sensible, logical approach to trading is what's needed, and if you need help with that, you know exactly where you can find me and find CCI Traders to help you. So the next thing, I've got another question. There are no, okay. So if you've missed bits of this, that's not a problem. I was asked about referring back to things and files that we can watch things again. This webinar will be at some point in the next day or two be available for you to watch as a recording. So you can watch this and refer back to areas there if you need to. Next question, does 1 to 500 talk about trading as a beginner? Leverage is basically what the brokerage, in this case CCI Traders, is offering you to be able to manage your trades for you. So they're actually giving you an enhanced leverage to allow your money work harder for you in the forward because your risk management is there to protect you. Look at what we've done today. Risk Okay, we should be back now. I do apologize. We had a little bit of a gremlin there. So the risk management side of things we've covered today will really help you keep the any losses low. So higher leverage means that you can get more on the trade. in trade sizing. And again, I'm going to cover that off a little bit more. We've covered risk management, but I haven't covered trade sizing, and I'll show you how that works next week when we do trading as a beginner. So good morning. I'm having to leave. That's fine. There's no problem. Okay. How do we get the $200 educational bonus? I like the sound of that question. So CCI traders are offering a $200 educational bonus for watching these webinars. So you only get it once, and it has to be used as you're trading in a certain period of time. So if you visit, I'll give you the website in a moment. It's .net. Contact them through that, and you then will basically get you'll get that sent back to you on how to apply for that. Okay, I've applied and haven't received it yet. Okay, that's fine. I can speak to CCI and find out. That's Joseph. So yeah, if you've applied for the educational bonus, I'm sure CCI will then forward that through to you in due course in the next few days or so. Okay. In setting your stop loss, what time frame will you be considering? Okay, so let me just explain to you. A stop loss isn't dependable on time frame. Remember, and I'll talk a bit about this next week when we talk about beginning trading. We have various different time frames we can trade. We have 1 minute, 5 minutes, etc., all the way through to other time frames, up to the daily, weekly, and monthly. So your stop loss is something you use regardless of what time frame you are trading. But what you would need to do is take into account any levels of support and resistance that you want to put your stop loss under. So I will go through that with you again next week with regards to where, how to look at support and resistance and how to identify areas in the marketplace. But yes, we can do that for you. So hopefully that answers your question. That's Chris. Okay, thank you so much. Can you help with learning from the beginning? Well, yes, we have. I'm talking to CCI traders right now. CCI traders are a brokerage, and obviously offering you broking facilities where you open your account and they will place the trades on your behalf once you tell them where you want to go by pressing the buy and sell button. But we're talking to CCI traders about how to help people at the very beginning, various educational workshops, that sort of thing. Right now we're in lockdown, so we can't really do anything live face to face wherever you are around the world, but we can do stuff online. So yes, there are things we can do. That's a great question. And yes, we can do some things like that for beginners. There's free content. There's also paid content as well, which we can look at maybe moving forward. Is the webinar every week? At this moment in time, yes, it is, my friend. This is the 4th week of the webinars. We've got another one next week, and I'm planning them week or 2 ahead as well. So the content that you'd like to see, if you want to drop us a line, CCI traders, we'll happily take feedback. These webinars are for you. They're not for my benefit. They are for your benefit. So if there's something specifically you would like me to cover, and it's something I can do within the time of availability that I have, it's not a problem. Happily come in and jump in and help where I can. Okay, I think, is there any more questions coming through? Are there any more questions coming through? Okay, nothing right now. So I have a question for you guys. I'm hoping that you've got value from today. And in the chat box, if you can just put a quick note to say yes or no, if you think you've actually enjoyed today and you've actually feel you've got a benefit and you've actually learned something today. Because I believe in giving value. I believe in giving education where I can, and that's great. Oh, fantastic. Thank you very much. Yes, so much. Thank you. Okay, great. That's really good. So, there's one other question here for the $200. When is it ending? Let's have a look. Go back to that one. When is it ending, or is it a permanent package from CCI? Well, it's there for now. I can't comment and I can't confirm one way or the other with CCI traders whether the educational bonus is there permanently, but it is there now. So let's take advantage of that now while it is there. Thank you so much. Thank you. Yes. Where can I learn from you directly? Well, that's something you need to speak to CCI traders about. We do have education packages and stuff, which I'm talking to them about. But I don't want to. I want that to, your CCI traders, your clients of them. I want you to go and contact them, and they can then help you moving forward with regards to that. But yeah, so I've got over 10 years experience teaching and traveling the world. I spend a lot of time spending a lot of time in South Africa, and I'm running another course in South Africa this weekend at the moment online. Okay, yes, okay, I can see that you want some more education because you don't know about trading. That's good. I want to learn to trade properly. Yeah, I fully get that. Absolutely get that. I have learned a lot from the various webinars of CCI. Thank you very much. That's really good. I have learned something. I've learned a great deal amount. Another one about the CCI Traders website. So let me just share my screen with you. I've got a little, it is the website address to visit to contact CCI Traders. There's a contact button on there. Open an account. So you can open up a live account with them. And that's where you can also contact them to discuss the educational bonus as well. And again, some of you have asked about further education or talking to me or training with me. Mention that in the email as well. And then I'm sure we can facilitate something along the lines for that moving forward. So we are back. And thank you very much. Very low spreads that make CCI extraordinary. That's good. That's a good thing to say. Thank you. I gained a lot. So the general consensus is, guys, you've learned something, which is giving me good feedback, and I like that. And the next one, as I say, we're going to cover off stuff about trading for a beginner. We've gone over time. We've gone over by 50% today. They're normally an hour webinar, and we're almost up to 1 hour 30 minutes. So I really thank you for your time, and thank you for staying. Some of you had to leave, some of you joined. What I would say, guys, is do 2 things for the next one if possible. If possible, the next one is 9 o'clock. Can you please try to get yourself registered and logged in by 529, 8:55 or 8:50, because we didn't have everybody on board until around about 9:10, 9:15 and late. So I'm glad you did arrive, even if you were late. The second thing is, watching on a mobile can sometimes give you a lag. And I can see there are people watching on a mobile and a laptop. And it's interesting to see the guys on the mobiles keep disappearing and coming back on. The laptop guys stable throughout. So if you do have the ability to watch this on a laptop, much, much better way of watching webinars like this. Okay. So all I want to add is, one more question, please. I would like it if you can have a topic on candlesticks and how to analyze in upcoming webinars. We have done that. We have covered that in a previous webinar, what a price bar is, what candlesticks are. And that's more stuff that we can look at moving forward, looking at trading for trading as a beginner next week. But then again, if you want some to talk to CCI later down the line about furthering that sort of stuff, we can. I can teach pretty much anything that comes to do with trading. So I run advanced workshops, etc. So I will leave that entirely with you. Thank you. And I look forward to speaking to you all you guys next week at the next webinar. Many thanks indeed, and bye for now.